market participants, particularly buy-side market participants, reap the advantages of extraordinarily robust and complex regulation that they never have to think about all of the time. We assume, and institutional investors assume, that when they have securities custodied at a bank or a broker-dealer, that those securities won't disappear. We assume that those securities won't all of a sudden be leveraged and gambled away that they can't have. We assume for a minute that there are sales practices so that the people who are selling us those securities, there are things that they can't do. They can't lie, for example. We assume that when they talk about returns, if they're talking about fund interest or something else, that those numbers have to be accurate, and there's actually formulas that have to be used when you talk about performance. We assume for a minute that those entities are regulated and examined to make sure that they're complying with the laws. So there are a lot of assumptions that when we're talking about investments in securities that we all make and we don't ever think about in any real way. The challenge is when we start talking about crypto in particular, none of those assumptions necessarily are true. And so we have quite literally hundreds of rules that impact the offering, the sale, the holding, the information related to the stock market. Those are rules by the SEC, rules by FINRA, rules by state securities regulators. And those have been developed well over a century. And they get layered on and tweaked. Every single year, the Securities and Exchange Commission tweaks a rule here, tweaks 20 rules there. They issue guidance. All of those things are built up. And when we have an asset like crypto, one of the biggest challenges is frankly, the greatest innovation of crypto has nothing to do with technology, but with the brazenness with which they disregard all of that. And so one of the things I think I find really interesting, is it becomes a thought experiment. This is good old-fashioned first day in business school class, first day in law school, securities regulation. Let's whiteboard. What do we think we need to make these markets work? What do we think we need to make people invest? What do we think we need for safety and soundness and stability and to prevent fraud? And how do we do it? It's a really interesting exercise. It's also a terrifying one to be doing with trillions of dollars. And unfortunately, that's where we are. So I'll start with, my members have some minor interests in digital assets. Frankly, their greatest interest in digital assets might be owning digital asset firms, not necessarily the digital assets themselves. Some of them do have digital asset holdings. But the reality is there are companies like Coinbase, right, that you might own an interest in. You might own a stock interest in Coinbase. You might own an interest in a venture capital company. That seems to be where a lot of, for lack of a better phrase, asset managers really started to get into digital assets. You might not want to gamble, but you might want to own a casino, right? And that makes sense, right? At a very basic level. Even if the casino game is rigged, it might be even better for you if it is, if you're the casino owner. That's one thing. But on the other hand, when we start looking at the digital assets themselves, they're all over the map in terms of integrity, robustness, stability, the ability to get information about them, all over the map.